All right, Jason, let's talk about QSBS. This was a really fun policy dive for me because I've never had to deal with it, so I didn't actually know it in enough detail. But for folks who don't know, it's called the Qualified Small Business Stock Exemption, or just QSBS in kind of the lingua franca. And it was expanded in the One Big Beautiful Bill Act. So, Jason, previously, QSBS allowed investors in a C Corp specifically that had assets of less than $50 million at the time of their investment to, if they held their stock for 5 years, not pay capital gains tax on up to $10 million of the value of their investment. So essentially, it was a bit of a loophole is a derogatory term, but a perk, a benefit for people who invested into smaller companies to not pay capital gains tax on potentially some of their gains. Now, it's been expanded in a couple of ways. First of all, instead of having to wait 5 years now to earn this benefit, you can now avoid capital gains tax on 50% of your holdings at 3 years, 75% at 4 years, and up to 100% at 5 years. Also, the cap has been raised from 10 million to 15 million. And even better, that will go up over time with inflation. And one last thing that I saw that changed in the bill is that companies can now have up to $75 million in assets instead of 50 at the time of the investment to give their investors this access to a tax benefit. I think that there's going to be a lot of people on your group texts who are very excited about this.
It's certainly a benefit if you are an angel investor or you're an LP in early stage companies. Now, if you're investing in Mira from OpenAI's $10 billion company, that doesn't count, right? Because if they raise $1 billion, they have $1 billion in cash. It's kind of hard to argue that company's worth less than 50 million. But if you were invested in Coinbase, if you invested in Uber, Airbnb, in that first couple of years, well, it wasn't worth more than 10, 20, 30, 40 million dollars. Therefore, you got this little incentive. If you put in, I don't know, $100,000 and it turned into 10 million, you wouldn't have to pay those federal taxes on that first 10 million in gains. So, but you had to hold it for 5 years. So you think about the timing of this. You have to really thread the needle. When you make the investment, it's got to be a tiny enterprise, under 50 million in value. They have to file and say, hey, the CFO of the company or the investors have to make a note on a piece of paper and say, yes, this company is worth under 50 million. It qualifies for QSBS. If you were to start the company and buy $1 billion in servers, you can't claim it's under 50 million. So this wouldn't work for, XAI or CoreWeave, at a certain investment level. But it would work for a software company or a social network, et cetera, marketplace. If you hold it, then you get this incredibly generous, if you were to save, 30% on your capital gains tax. And I think it's just the federal tax. If you save that money, you can save a couple of $1 million. It's kind of like a little pot sweetener. It's not enough to drive people to become angel investors, to become LPs in seed funds, but it's certainly nice. And it does come up in our world. Hey, was that a QSBS company? Fantastic. My first $10 million in gains. And typically it's like a gain of $1 million. So you're talking about somebody saving low 6 figures, in the average case, or high 8 figures. It's not as juicy as it sounds. It's nice. It does, I think, drive people. If they got rid of it, I think you'd lose 20, 30% of angel investors. So there are, I would say, 1 out of 5 people who consider this like a driving force for them. And it got them off the benches. And we should be thinking more and more about this. Now,